Marshall and Sagar here. Welcome back to the Realignment. This week, we're really excited to bring you an episode with Heather Long. Heather is a economics correspondent at the Washington Post. And what's really valuable for us, I think, and I think will be valuable for you guys as listeners, is Heather is an actual reporter. So, we have people on like Matt Stoller, our last episode, where they're talking about their hypotheses, their thesis, how they think things are going to play out. But Heather, because she's actually writing about the economics of the coronavirus and how the actual jobs picture is going to look, is able to bring in people's actual stories and really mix that in with data. So we started off with just the really harrowing point that right now we have a 14.7% unemployment rate in terms of last month's jobs report. And she also goes into how if we actually look at the broader sort of macroeconomic factors, that unemployment rate is probably closer to 20%. The other thing that I was really interested in was the discussion over how small businesses and then different industries are going to cope with the lockdowns. So is that restaurant that you've grown up next to for the entirety of your life, is it going to survive the crisis? Are movie theaters, ride share apps, all the sort of businesses we've grown used to, are they going to be in the same sort of state after the lockdowns end?
And everybody who listens to the podcast knows that one of the things that concerns me most is about the government response to this pandemic. And that's something that Heather's kind of nonpartisan expertise was really great to discuss with, just the size and the scope from her perspective of the long-term fiscal implications of the government spending package. We're not the same country that we were in 2000 and after 2008. We're a different country after the coronavirus crisis. And the biggest thing that we got into, of course, was about reopening the economy in addition to these fiscal discussions, because the discussion really all has to be about what kind of country are we going to be living in after this coronavirus crisis? What are the different state responses that we're starting to look like? And ultimately, what are we going to decide as a society that we value and we don't whenever it comes to economics? So with all that being said, one of my favorite episodes we've ever done. Let's dive in.
Heather Long, welcome to the Realignment.
Great to be here.
Good to see you, Heather.
So we really wanted to base this show around your reporting in the Washington Post, which has been really helpful. And I think I think best to simply say this, the unemployment rate reached 14.7% last April. And, if we look at the speed of how quickly that rate shot up, that's a quicker rate of joblessness than any time since the Great Depression or the Great Recession. And that's coming from you, obviously. So how should we react to that? It's hard to fathom that properly.
It's incredibly hard to fathom. And I think to start, the true unemployment rate is more like 20%. So what we learned in April is we had 23 million Americans who were officially unemployed. But then we had 10 million more who probably should have been counted in that number. And the reason they weren't is for a technicality. In order to be counted as officially unemployed, you have to be actively searching for a job. And of course, in the middle of a pandemic, a lot of people are not actively searching for a job. A, because there aren't really very few jobs to be had right now. And B, you're obviously not going to walk around and be handing out your resume right now. Mm-hmm. So I think I keep the figure I keep in my head is 20% right now. You've heard the White House say it. Chief economist over there, Kevin Hassett's been very clear about that. So basically, we're pretty close to 1 in 5 Americans, out of a job right now, and 1 in 5 American workers.
Yeah. And obviously, most of our listeners were not alive during the Great Depression. So I think the better reference point is the Great Recession. So this is September, October of 2008. Like, how quickly did job losses sort of go during that period?
It took much longer. We've basically seen in 2 months what took almost 2 years during that Great Recession period. And also, when we talk about this 23 million or more being unemployed, that's basically double the worst of what we saw from the top to the bottom during the Great Recession. So both in terms of the speed of which is happening and the deep, deep losses that are happening. What I'm learning and what I think is new, and you heard the Federal Reserve Chair say it recently, Jerome Powell, there's beginning to be agreement from everybody from Goldman Sachs to Fed Chair Powell, maybe to the White House, that May is probably the worst month. This is the ugliest period right now. But the huge debate is how quickly can we turn around?
Right.
And what really scares me is the consensus view right now. So from Wall Street, from a lot of independent forecasters, is that we will still be at about 10% unemployment basically a year from today. And that's what's scary. So we're thinking we're going to get quite a few people back to work, but still have possibly 15 million, that type of magnitude, unemployed a year from now. And how you think through policy, how you think through what American society looks like that is totally mind-boggling and something we really haven't grappled with yet.
I'm glad you took it in that direction, Heather, because that's something I've been very interested in as well, which is that the optimist case that I've seen is, well, it took 2 months to put all these people out of work, kind of the V-shaped recovery thesis. And what that looks like is, well, a lot of people are going to go out of work because the restrictions are there, and once we reopen the economy, then things are going to begin to scale up. Is there any data point, like across the world in order to support that thesis? And why is it that the consensus seems to be that we're going to be stuck around 10% unemployment from a year from now? Because as we both know, I mean, that is still like a Great Recession level event in and of itself in a post-recovery age.
Yeah, it's an excellent point. So I'd say some of the most optimistic reads on the economy right now are actually coming from workers themselves. And what I mean by that is the Washington Post and Ipsos had a poll we did the last week in April and the first few days of May. And we found that nearly 80% of workers who have been laid off believe they will go back to work. They will go back to their old job. And that's been echoed in other findings. The Federal Reserve just put out a report from a big survey they did of laid off Americans in early April. And they found 90% of the people who were laid off that they talked to think they will go back to their same job. So, that's a lot of optimism from these workers that what they're experiencing, whether it's a V or a U or whatever letter you want to pick from Sesame Street, But the point is people think they will return in the next coming months. The reason that I'd say economists, it is called the dismal science, not for nothing, are a little bit gloomier is as I talk to small business owners or even large business owners, it's what I call the zombie economy. It's the 50% economy. Yes, we're reopening, but does your restaurant need as many workers if only half the tables are full? Does your airline need as many workers if, yes, we get some people back on flights, but we're certainly not going to be back to the flight levels of January and February? And so that's where you get these predictions of, basically half of the workforce going back and half not.
That's one thing I wanted to focus on with you as well, Heather, and I was very concerned with the recent comment by the Federal Reserve Chairman Jerome Powell in that press conference you're talking about, where he talked about how 40% of the people making less than $40,000 in America were unemployed in March alone. So that's not even April data. That seems to be just an absolute disaster for the working class of America. What do we know about how that will be affected in what we're talking about here? Because are they going to be disproportionately represented in the future unemployed relative to what we know about how past kind of like outside shocks, like say 9/11, affected the airline industry and affected tourism industry? How do we know about what outside shocks and how the lowest skilled and like the lowest class of workers in America are generally affected by this in the long run?
Yeah, it's a great question. There's no doubt from the last two recessions that you're speaking of that we have seen a dramatic shift in this country where lower skilled and lower educated workers, so we're speaking about workers without college degrees, have had the hardest time bouncing back. It's taken them the longest. And it's interesting, even in Federal Reserve had done a survey last fall, and they were asking people, do you feel financially secure? Questions like this. And pretty much most of America was saying, yeah, we feel better. This was fall of 2019. We were feeling pretty good. But the one and key group that was saying was actually trending down was Americans with high school degrees. Or less. They were still really struggling even before this pandemic hit. So I think you're right that we know from history and we know even from recent months that this was a really fragile population. I think what's interesting this time, there's so much impact, and we can see it in the data. By far and away the biggest sector hit is hospitality. It's the hotels, it's the entertainment venues, the stadiums. And so I think really drilling down and understanding that workforce is going to be key going forward. And you can see we're not going to have stadiums filled, again, anytime soon, as much as I'd like to go to baseball again.
Yeah. Something I'm curious about, because I was just struck by your point about the optimism of a lot of workers, because when I sort of think about this, I think of the different industries that we're talking about, right? You've spoken about this, right? So if we're talking about events businesses, if you're talking about restaurants, I guess it's just hard to see in a lot of these industries. Like, is there any sort of breakup in that breakup by sort of sector of where people are the most optimistic? So is there sort of a sector you could think of where there were all these layoffs in March, but we could quickly see coming back? Because I just don't see that.
Yeah, it's a good question. I would actually say construction is
Right.
what we've seen in the data. And it makes sense, when you think about it, because I was just walking by a construction site recently and, they've got the gear. They have the mask. They're used to wearing this. They're used to dealing with different processes and procedures that need to safety procedures. So, there was, in many states, construction was still considered essential and that continued. But I think that it did dip, and you can see that in the data. Certainly over 1 million job losses in construction in March. But as spring, as the weather warms up, normally we see an uptick anyway. So I'm optimistic there. I'm slightly optimistic on manufacturing. Similar story there. You're starting to see. I think it was the Volkswagen big plant out in Tennessee. It's just announced. They've implemented, I don't know, something like 7 or 8 new safety procedures, and they're ready to reopen. They're ready to go again. Again, are they going to need 100% of the workers that they needed in January or February? To me, that remains to be seen. Because again, you can imagine a scenario where workers used to be, 2 or 3 feet apart, and now they have to be 6 feet apart. Or you just replace a few of those people with machines. That's really the debate, I think, that's going on among a number of economists. How many people would potentially be replaced by machines because of this?
And something I'm curious about too is, there is the broader phenomenon of work from home sort of spreading. And I think this plays into the dynamic around construction. There's a lot of debate about whether or not after effects of COVID-19 will lead to sort of moves, especially with white collar workers, away from cities. And that's the type of thing, if you look at a place like New York, right, where everyone's really reliant on public transportation, there are so many spillover effects, right? Because if people aren't going into offices as much anymore, that's going to affect the falafel stand right below them. That's going to affect bars that are around. So how do you think that debate plays into everything?
It's huge. This is probably I used to live in New York City, and now I live in Washington.
So did we. So we
get
feel
it.
this viscerally.
And this is probably the debate that I'm having the most with my inner circle of friends and family is, I would say at the moment, I haven't seen any good data on this, anything that really points to me what the magnitude of this could potentially be and who's going to benefit. Are people going to move from New York City to sort of mid-sized cities, next tier cities like Charlotte, North Carolina? Are they going to move, way out in the suburbs or the country? That to me is not entirely clear. Anecdotally, I will say, what I'm starting to see is, I talked to a woman, she was profiled in a recent story I did, and she ran just what you're saying. She ran a restaurant, popular restaurant in downtown Cleveland. It was a hot lunch spot. She decided to close permanently. In the last few weeks, she made that tough decision for just what you're saying, because she thinks it's going to be a long time, even in Cleveland, before people are back downtown. And, after the story ran, we were texting a bit more. And I said, you seem like such a great person. I really hope the best for you. And she texted me back that she's thinking of moving to Ireland. So there you go. I mean, there's someone an integral part of downtown Cleveland as a business owner and as a resident. She went to a local Catholic church. She actually donated a lot of her materials that she used in her restaurant to this Catholic parish for their food pantry. That she was an integral part of this downtown. And now she's like going to about as far into the Irish countryside as you can get.
Right.
And so I don't know how many stories are like her. I don't know, but I think you're right. There's things will alter.
One thing, Heather, I've seen a lot of there's jokes about it, there's memes, there's speculation, which is, we'll see on the exact same day that the unemployment numbers will come out, the S&P 500 will jump by like 2%. And nobody can really understand why. I mean, could you give us the best explanation I think I've seen from Josh Barrow is that the stock market is a leading indicator, that unemployment numbers are a lagging indicator. But there's something that seems in between, because a lot of Americans, they look at that and they say that the stock market seems disconnected from my reality. What's your read on the situation?
Yeah, totally.
Yeah.
I think it's 50% Josh's explanation, that the stock market's looking about 6 to 12 months out.
Yeah.
And you can certainly see it jump on days when there was news of potential vaccines and breakthroughs and these sorts of things. But I think the other key player that everybody seems to forget, we're also focused on Congress and the White House sometimes, is the Federal Reserve.
Mm-hmm.
And there's almost a 1-to-1 when the Federal Reserve makes these big announcements that they're going to do more market interventions, boom, the stocks go up. What happened in early April when the stock market turned? The Federal Reserve came out and announced that it was going to buy corporate bonds for the first time, that it was going to buy state and local bonds for the first time ever, that it was going to make direct loans to small and mid-sized businesses through a Main Street lending facility. The basic message from the Fed right now, the central bank, is we will backstop this economy, particularly so that big businesses can borrow.
So something that, and once again, we're just citing your reporting here, so I really appreciate it, was just the point that, it took 10 years to really recover to bring us down to sort of a 3.5% unemployment rate you had right before this crisis. And there's a lot of debate about how long it's going to take to get back to that 3.5%. So obviously we're not going to be able to predict the sort of rate at which we can recover, but what are the sort of factors that we should sort of be thinking about? Because there's obviously like this broader economic picture that was going on during the 10 years after the Great Recession. So how should we think about the sort of ways that's going to go down?
Yeah, it's a great question. And it's more complicated because of the nature of this crisis. So the number one thing, and it sounds so obvious to say, but we kind of have to say it and get it out of the way, and that is a lot of it's going to depend if there's a resurgence. If we got another, I warned in a piece a couple weeks ago, what we really don't want is a W recovery, where we sort of just think we're getting people back to work. We just think things are getting better this summer, and boom, there's another huge explosion of coronavirus cases and, God forbid, deaths. And then we really have to shut everything down again, or a lot of things. So that is kind of your nightmare scenario for the economy. And just nobody really knows on that, I would say. In terms of what we learned from the Great Recession, there's probably 3 lessons that were pretty key, I would say. Number one is everybody wishes that Congress and the White House back in the day in the Great Recession, that they had gone faster with the help, that they had done more with the help, and that they had done it longer. And so I think this time around, we've seen Congress and the White House have learned the first 2 lessons. They've done close to $3 trillion worth of relief. That's a lot. They did it pretty fast. I know we can argue if it was fast enough, but as anybody who's been around Washington knows, that was lightning speed.
Yeah.
Yes.
They deserve some credit. Republicans, Democrats, White House, for getting going quickly. The big question mark, and this was a huge part of why things didn't turn around so fast last time, was we didn't stick with it. And again, you're sitting in a moment now where, there's a scenario you could tell, there's a story you can tell where things get a lot better from here. We are in the V, it gets fast better, just like the president wants. But there's a story you can tell where we limp along in this zombie economy for a year. And again, we're sitting here with 10% or more unemployment a year from now. If there's even a chance of that, which is what the Fed chair was trying to warn recently, if there's even a chance of that, why wouldn't you do everything you can to try to prevent that? To prevent a lasting recession or depression.
And I think the sort of devil's advocate, not that you're inherently like advancing a position here, but the concern about, especially sort of on the Republican side, like the national debt and our spending levels, like that was definitely sort of the debate about austerity politics. Like how should people be factoring in the sort of long-term versus short-term trade-offs from an economic perspective?
I mean, look, you're right. And much like Fed Chair Powell, I've been someone, if you go back and look at my early writing from even a decade ago, who was warning about the debt. And in hindsight, I probably shouldn't have been so loudly screaming, 10 years ago when we could have used some more screaming. So I'll say a mea culpa on that. But, I think I think when you sit here now, the easy answer, the easy out is, well, if we just did good spending, it would be worth it. So I think
Mm-hmm.
most people agree, whether infrastructure spending, most people agree a little bit more help for small businesses, whether that looks like a tax cut or whether that looks like more grant or loan money, Congress can decide, but a little bit more help for unemployed. It looks like they're going to be out of work longer. There's kind of potentially a little bit of help for states and municipalities, not totally bailing them out, but doing a little so we don't have mass layoffs there. You can sort of easily see a compromise package of another, whatever, 2-3 trillion that would get you through the hump, and it would be really hard to argue they didn't do enough to try.
Heather, let's flip it on its head though. What have the deficit hawks gotten wrong? Because one of the things I have heard constantly is, oh, you can't spend all this money, there's going to be runaway inflation. Well, as far as I see, there's record low inflation, like the lowest inflation on record that we've seen. Now, look, in terms of the way we calculate it, everybody's like, no, you can't factor that in, food prices, etc. What have deficit hawks gotten wrong about this crisis?
You're right. That's a really good
Everyone has a perspective.
Let me just say I've been a chief opponent of these people for a while.
You made a good argument there. I think the other one that it's hard to remember back to 2008, before 2008, I was actually working in London financial circles at the time. And, people forget that in 2005, 06, 07, there was a real belief that the euro could be as strong as the dollar, that the King Dollar's days were ending. And the financial crisis of 08, 09 really changed that. And, anytime somebody makes an argument to me, oh, Bitcoin or whatever could potentially rival the dollar, the reality is the world will probably only ever have one true reserve power currency. Because whenever there's a crisis like what we're experiencing right now, people flee to the stronghold. And what people underestimated is the United States, once again, is seen as the stronghold. Sure, we've got our problems. We've got our economic problems, but relatively speaking, our economy, and in particular, our debt instruments, buying either our sovereign debt or, US Treasury bonds or buying our corporate debt of our companies is seen as so much of a better deal than buying Europe or Japan or, are you going to go buy emerging market right now? And so maybe some, but that's a very different type of bet.
Right.
And for all these pension funds around the world, for all these endowments, they are pouring into US debt. And that has helped, that's helped fund all this. And it's helped make this even cheaper to borrow. And I don't think any of us, or very few people, predicted that.
So one of the things you mentioned there with the $3 trillion, and we should give Washington credit, you're right. I mean, getting that amount of money out the door so quickly is impressive. There's a lot of questions about the distribution there on that, though. Mm-hmm. And, the leverage power of the Federal Reserve and its ability to, concierge service for some, and there's endless stories about, X company got Paycheck Protection Loan Program, which is the small business loan program for payroll, and the other didn't. You just recently tweeted that 100,000 small businesses are permanently closed. And the question is, how do we appropriate $3 trillion and something like that still happened? What do you think, what's going on there? What is it that because people look at that and they go, I don't understand. I thought we just spent all this money.
You can hear me take a moment to breathe on that one. This is a deep question, and I would say the biggest regret looking back is probably going to be on both the Republican and the Democratic side, that we didn't do what the United Kingdom and Denmark did, which is just directly give money to companies to keep paying people at about 70 to 80% of what they were making before.
Yeah.
Those countries have not experienced nearly the spike in unemployment that we have. They certainly don't have people who are sitting around, unable to get their unemployment check or unable to get their PPP loan. It was a much, much smoother process. I like simple. When it comes to economic relief, the simple is the best. And actually, if you look at all these programs that the government has done so far, the simplest one has been, bizarrely, getting out $1,200 checks to people.
Yeah, which actually happened quite fast. Right?
Yeah, the easiest one to understand. It went the fastest.
Yeah. And
that's kind of the same model and you can, I was surprised to see some Republican senators, Josh Hawley of Missouri, even said, why didn't we do what the United Kingdom did?
Yeah, so let me pick it up there, which is that, I've been open disclosure, I've been like openly trying to push this plan for a while publicly on my show on Rising. And one of the things that has really frustrated me, Heather, is that this is a fringe position on the left and the right within both parties. I mean, we saw recently an explicit choice by House Speaker Nancy Pelosi not to include this program in their, I think, $3 trillion Phase 4 bill. And as of the day that we're taping this, only 2 Republican senators, Senator Cory Gardner and Senator Josh Hawley, are the ones who are pushing this. I mean, both kind of seem wedded to a ad hoc program distribution appropriation and not just the simplicity of paying people on their payroll. I mean, I don't want you to get political, but this is a bipartisan thing. What is the holdup in both parties towards something like this?
From an economist point of view, it's baffling.
Yeah.
And I will admit, I don't fully understand it. To me, it's much simpler for both businesses and workers to do that. And certainly it's hard to argue that other countries who are doing it are having much better success than we are right now.
So something I'm curious about, and maybe these are just sort of like Twitter debates, but I think of a lot of people talking about how the Paycheck Protection Program and other efforts are basically just sort of propping up wealthy, small business owners, people who run companies. We should be protecting people, like not the businesses. This idea that there's going to be this creative destruction, and there are all these sort of industries that were sort of already on their last legs. Like retail, obviously, is an example of this. So how should we, how from an economist perspective, should we sort through the categories of small businesses that are failing, right? So there are ones that were in a difficult spot before and probably didn't have much legs in them, and it maybe wouldn't be the best sort of public policy decision to prop them up for longer, and instead we could just support their workers who are leaving. And what are the businesses that have really sort of been, through no fault of their own, pushed away? How should we think about that?
I'd say the Treasury and the Federal Reserve spend most of their time right now thinking about where is this line? You're right. Where do you draw this line? How do you create a formula to help some companies that deserve it and probably could, other than the pandemic, would have been just fine here in May, and ones that were already limping along, and you're essentially truly bailing them out from a situation that they probably should have gone under, from real capitalism from happening. It's particularly complicated this time around because you look back to 08, 09, and it was easy to get angry. Companies clearly made mistakes. Some did things that were illegal, and so providing aid to those companies was really hard to stomach. You truly were bailing out bad business decisions and too much risk taking. I think it's so much more complicated now. This is a pandemic. Like, could you really expect that small corner shop that had finally survived the Walmart moving in and had finally survived the Amazon retail apocalypse, and now they're going under because of the pandemic? Like, is that really something that we should? I don't know. Right. So this is tricky. I will say the thing I keep balancing in my head is, going back to what's the best thing for workers. At the end of the day, when I talk to people across the country, wherever they are on the political spectrum, they want to go back to work. Think back to that optimism of, almost 80%, if not more, workers want to return to their old job and hope and think they will. And so the more companies that go under, whether they're big and we don't like, whatever, and some people may not like them, or whether they're the small corner restaurant or shop, the more that go totally out of business, the fewer places for those workers to return to later on.
Right. One thing I want to get with you, Heather, is about the efficacy of the intervention so far. So we talked and we praised the $1,200 checks, but I just saw a recent news item that Chase customers, for example, Chase credit cards, say that their consumer spending is down 40% in terms of the normal levels that we should see right now. So even with people, that's not even necessarily people who have lost their jobs and people who have now received stimulus checks. In terms of our consumer spending, is it even possible for the government to stimulate the level to not go into a recession?
Not forever. Think about the basic numbers. We have just over a 20 trillion economy per year. So every quarter, that's 5 trillion, give or take, of economic activity. And basically the estimates are that we've lost, give or take half of that here in the second quarter that we're sitting in. So that's 2.5 trillion, which is basically the amount of money the government has already spent to try to do some relief. So, these numbers are kind of similar in that regard. Again, it's just so hard to know going forward how much of that 5 trillion is going to be lost in the third quarter, how much in the fourth quarter. And so that's the bet you're making. The more you sort of spend up front, it's almost like an insurance policy. The more you spend up front, the less you hope it dips later on, and instead you hope you get on an upswing trajectory and you don't have to keep spending more after the next the next wave.
Right. So for our last section, I want to dig into the state-by-state reopening situation. So we were speaking with Michael Lind, who listeners of the podcast will remember we opened our first episode this season with, and he was talking about how something that people are missing in the reopening debate is, even if, a small town, let's say you have a small town that reopens in Wisconsin, if we're looking at the broader economic picture, though, if New York isn't capable of reopening, it's not as if the actual economy as a whole is going to get better, because so much of economic, power and growth and sort of spending is concentrated in these regions, these urbanized cities where there are always sort of problems. So like Los Angeles, for example, part of the, issue of Elon Musk is that LA is pursuing different reopening policies in other parts of the country. So how will the staggered reopenings and the dynamics between urban and rural regions really sort of affect the picture?
Another pretty deep one.
Yeah. That's what we do here.
Yeah, I can tell.
Yeah.
Again, this is exactly the discussion that I'm having with a lot of economists that people are trying to get better numbers on right now. And a lot of it's going to depend on this ongoing debate. I think these cities, New York and LA, have made this decision that we're going to stay closed for longer in the hopes that when we finally do reopen, we are guaranteeing that we won't have to shut down again.
Right.
Whereas the verdict's still out. Are some of these states like Georgia that were early to reopen, are they going to have to shut down? Are they going to have to take more extreme measures later down the road? Are people really going to feel that comfortable? So the best thing I've seen so far, the smartest thing, is you look at China, right? China in this process is maybe 2 months ahead, maybe 3 months ahead of us. And I think what's interesting in their data so far is spending has come back. You were mentioning that credit card data being down, but it's still down about half. Their retail sales, a lot of their kind of key marketplace areas or casinos and stuff, it's still about half. And we haven't really seen this breakthrough where it gets better than about half of spending that was lost coming back.
And as I understand it, Heather, what percent of our economy is consumer spending? Like 70%, right?
Right. In the United States, we're even more dependent with 70% from consumer spending.
Yeah, well, that's a depressing step. Another thing I want to get with you in reopening and kind of the future and what it'll all look like that I've been particularly concerned about is about the possible consolidation in the economy going forward. So we see big business, and as you're talking about the Federal Reserve, and I've seen internal bank reports talking about how they're not particularly worried that the Fed has given them a signal that they will be backstopped in the markets. So we're going to have a kind of at least survived financial sector, and at the same time, we're going to have a whole lot of distressed assets all across America. Does that set the stage for a mass consolidation? Is that something that people are worried and talking about right now?
Well, I think the best indication of that is big law firms are preparing for a wave of bankruptcies and mergers. And that's the best indicator you can get of what people think is coming. The good news would actually be if there were more mergers, right? At least something surviving. Yes, there will be some changes or whatever, but you're not totally wiping and losing something forever. It's morphing into a next phase. It's creative destruction in the economy. So I would actually take that as kind of a positive sign and a positive vote on what could be coming from the future. I think the key thing to watch there, the energy sector is obviously in huge turmoil right now. I've seen some estimates that over 500 U.S. companies in the next year will either have to go out of business or merge. And so I think watching what plays out in the oil patch will be very indicative of where confidence really is in the business sector.
So my sort of last question is, if you're one of our listeners and you're hearing all this, it's pretty depressing, obviously. And Sagar and I are lucky enough that we're still employed. But if you're one of those people who are stuck in an unfortunate situation, how should they just be thinking about their world right now, right? Because I feel like what must be so tough is just not knowing what next month is going to look like, what even next week or tomorrow is going to look like. How should they be thinking about their world and the way it's changed since January?
Well, I think there's kind of maybe two or three different responses to that. One, it's really hard. If you were someone in the hospitality sector and you lost your job, that looks like that's going to be some of the last to come back. That's a huge income loss. I was talking to a woman in the Panhandle in Florida. I used to work at a resort at a spa. What really got to me, not only has she started to think it was a temporary layoff. Now she's been told it's pretty much looks like permanent. She's going to lose her health insurance, and she just put her house up on the market. That's a total lifestyle change that's coming for her. And I worry a lot about those people. How many people like that? I don't know what to say to her. She was like, normally I just try to move. I'm in the hospitality and tourism sector. I might try to move to Las Vegas or somewhere else, but right now there's nowhere else to go. And so it's hard to give advice to those people. I have more optimism for our small businesses. I've talked to several. I interviewed one in a piece recently. The owners of 3 yoga studios in Fort Worth, Texas. They ended up closing their physical studios, but the 2 owners, this great husband and wife, a Yoga Power, I think it's called, no, excuse me, Yoga Project. And you can go on their website right now, and they are now totally reinvented their business online. And we've seen that in DC with that famous Sushi Taro restaurant.
Right.
They've done the same thing. They've said, we are going to close our physical eatery, but we are still going to create a takeout business, totally takeout. Now that's different. It requires different types of workers, but I think that's a good sign if we see more people saying, I'm going to try to create something new out of this. But the key thing to watch going forward after the Great Recession, one of the biggest drags on this economy is A, business investment was low, and B, startups, new business creation in the United States was anemic. It was at a 30-year low for most of the past few years. Even as the rest of the economy recovered, people still were hesitant to start something new. And if we see that again, I think it's really dangerous for the economy going forward. We need these incubators. We need people to try things in this country.
After every large economic crisis, we all kind of come to a consensus. What do you think some of the consensus might be coming out of this one?
Ooh.
2 words or less, no words.
Well, okay. Government matters.
Oh, wow, that's actually
that's important.
Good. That's good. That's good.
Both state, local, and federal, and international. I mean, hello, can we get some World Health Organization intervention here? I think it's a key one, I think I'm hopeful that there'll be a little bit more of a rethink in the United States about things like, paid sick leave, paid parental leave. I know we've been talking about it for a long time, but, I think we're seeing there's a lot of situations where we got to take care of people a little bit better than we do. We don't want to be this great country that's letting people, have COVID-19 and feeling they're forced to go to work. That doesn't feel right to me.
Last question for you, Heather. One of the things that we saw after 2008 and after the Great Depression is that people fundamentally changed the way that they consume products. So after the Depression, of course, there's all these stories of people who grew up with nothing and who for the rest of their lives didn't trust the banking system. After 2008, the way we flew, the way we went to theme parks, these types of things, it just completely changed. The way that we went and shifted some of our spending online. What do you think as a result of this pandemic that we're going to see in differences in terms of consumer behavior and just societal change overall?
That's a great topic. One of my colleagues is writing on this right now, Andrew Van Dam. He's amazing, and he's our data guru. And that exact point. I've had some economists make that to me as well. Particularly, okay, so We know that the 20 people in their 20s were laid off a greater share than other generations. So you're right. That could easily be another Great Depression era generation where they don't spend well for the rest of their lives. And then you think about a lot of 30-year-olds, it's like a double whammy because they faced the Great Recession and now they face a second one. So even if you sort of got back your mojo, like now you're hit again. So we obviously, after Great Recession, obviously seen delayed home buying, delayed family formation, people not settling down as fast. So you're right, that could be exacerbated. And the savings rate obviously has spiked hugely. I think you're right. Basically, I'm saying you're right.
Heather, thank you. This is such a great discussion. Everybody can follow Heather's reporting at the Washington Post. Absolutely fantastic. And on Twitter. Thank you so much for joining us. Really, such a great episode.
Thank you.
Thanks, Heather.
Hope you guys enjoyed this episode. Once again, we'd like to thank you guys all for sticking with the podcast during the COVID-19 pandemic. Each episode is doing better than the last, and we all need to keep it that way. Seriously, it means so much to both Marshall and I that we're going against industry standard because so many of you are just amazing, amazing listeners.
Yeah, and I think that what's been really cool for us is that, the whole thesis here has always been people have their commutes, we'll do these 60-minute episodes, we'll go deep. That's exactly the sort of thing that has been doing that well during the lockdown. So the fact that every episode does better every single week, the fact that we're getting more ratings every single week, we're starting to see organic growth of this podcast, that really means a lot. Keep at it. Rate us 5 stars on Apple Podcasts. Share it with your friends, share it with your family, and we'll see you next week.